Most traders believe that a 3-to-1 risk-reward is the holy grail. Risk $1 to make $3. Easy math, right? But here's the secret. Almost nobody tells retail traders. A simple, boring 1-to-1 RR often beats the glorious 3-to-1 in real trading. Not theory, not textbooks. Real execution, real psychology, real accounts. Today, I'm going to break down exactly why 1-to-1 can outperform 3-to-1. And by the end of this video, you're going to rethink how you trade forever. Let's get started. 1. The big lie of trading education. Every course, every guru, every ad says, always aim for 2-to-1 or 3-to-1 risk reward. And on paper, it looks perfect. You only need a 33% win rate to be profitable with a 3-to-1. But here's the problem. Trading isn't done on paper. It's done on charts, with emotions, with uncertainty, and with real money. What looks good in a PowerPoint presentation often collapses in real-world trading. Why? Because to hit 3-to-1, you need bigger moves, longer hold times, perfect trend continuation, zero hesitation, and a clean breakout with no fakeouts. How often does that actually happen for retail traders? Rarely. 2. Reality. Check what's actually achievable. Let me ask you, how many times have you been in a profitable trade where you were up 1R, then 1.5R, and right before it hits your target, it reverses? You watch all that profit get eaten alive. Most retail traders experience early reversals, fake breakouts, consolidations, sudden pullbacks, stop hunts, emotional exits. The truth is, the market gives 1R way more often than it gives 3R, and retail traders are terrible at holding for 3R consistently. 3. The math they don't show you. Let's compare two traders. Trader A, 3-to-1, RR wins 30%, loses 70%. Risking $100 per trade. Wins equals $300. Losses equals negative $100. After 10 trades, 3 wins equals plus $900. 7 losses equals minus $700. Total equals plus $200. Looks okay. But Trader B, 1-to-1. RR wins 55%. Loses 45%. Wins equals $100. Losses equals negative $100. After 10 trades, 5 wins equals plus $500. 5 losses equals negative $500. Total equals break even. Now watch this. Most retail traders with a tighter RR 1-to-1 don't win 55%. They win 60 to 65% because 1R is easier to hit. Redo the math. 6 wins equals plus $600. 4 losses equals minus $400. Total equals plus $200. Same profit, but way easier psychologically and technically. And here's the punchline. Most retail traders do not hit 30% win rate consistently with a 3-to-1 RR, but they can hit 50 to 65% win rate with a 1-to-1 RR. 4. Psychology, the silent account killer. With 3-to-1 RR, you will experience long losing streaks, fewer wins, missed targets, emotionally draining trades, fear of entering, fear of holding. This destroys discipline. With 1-to-1 RR, wins come faster, confidence stays steady. Drawdowns are smaller entries, are easier exits. Our realistic emotions stay controlled. This keeps traders consistent. Here's what most people don't understand. Your edge is not in getting huge winners. Your edge is in being consistent enough to stay in the game. 1-to-1 RR works with human psychology. 3-to-1 RR works against it. 5. Market structure. Why 1R happens more often. Let's talk structure. When price trends, here's what usually happens. Impulse, pullback, impulse consolidation, breakout, retest, continuation, liquidity grab, move, stall. Notice something? The first move after a breakout or pullback usually travels 1R easily, but the second and third extensions, the ones you need for 3R, are much harder to catch consistently. The market doesn't trend cleanly enough for most retail traders to get 3R regularly, but 1R is offered every single day, in almost every session. 6. Backtesting versus real trading and backtesting. You can see the entire chart. You're calm. You don't have fear. You take every setup. You don't hesitate. You don't move your stop. You don't close early. In real trading, candles move. Live wicks. Appear suddenly spreads. Widen emotions. Spike news. Hits you exit too early, you adjust targets. This is why 3-to-1 works in backtesting, but fails in real trading. 1-to-1 works in both. 7. Why smart money loves 1-to-1. RR institutions take partial profits constantly. They don't aim for 3-to-1 on every trade. They accumulate small edges. They aim for small imbalances, quick liquidity sweeps, fair value, gap fills efficient exits. Retail traders chase home run trades. Smart money stacks base hits. Guess which one wins long term? 8. Practical method. How to master 1-to-1 trading. Here's a simple rule-based model. Step 1. Trade only with the trend. Use VWAP EMA 9/EMA 21. Structure highs/lows. Step 2. Enter on pullbacks, not breakouts. Breakouts fail. Pullbacks equals stable entries. Step 3. Set your stop based on structure, not emotion. Below swing low if buying. Above swing high if selling. Step 4. Set TP at 1R. Whatever your stop size is, your target is the same size. Step 5. Close the charts after entry. You can't manage emotions if you keep watching every tick. Step 6. Trade 3 to 5 setups per day. Max. Consistency greater than overtrading. 9. The secret advantage of 1-to-1 RR. Here's the real magic. You can scale size safely. Your drawdowns are smoother. Your psychology stays intact. Your win rate gives you confidence. When you feel confident, you trade better. You follow rules. You stay disciplined. You survive long enough to win. So, if you're tired of inconsistent results, tired of missing big targets, tired of unnecessary losing streaks, try the simple, clean, realistic approach. 1-to-1 risk-reward. Not because it's boring, but because it's consistent. And in trading, consistency beats everything. If you want a full 1-to-1 RR trading indicator or a complete setup guide, comment 1-to-1 strategy and I'll make it. Thanks for watching. Trade smart, stay disciplined. See you in the next video. Checkmark.